Hello everybody, welcome to Know Your Money. I'm Bronwyn Wayner.
And I'm Craig Finch, and we are from Growth Financial Planning. We hope you enjoy our podcast.
Hello everybody, we have Sean Hanlon back from BrightRock, who's the Executive Director of BrightRock. Sean, thank you so much for being here again today. What we thought to maybe kind of unpack a little bit is in our previous episode with you, you described how BrightRock is doing things differently. So first of all, I just want to kind of explain for the listeners. So you can have life cover, which is a whole of life generally in the industry. So you have that cover, you take out the R1 million and you'll have that cover for life. Anytime you pass away, that would pay out.
Doesn't matter how old you are.
Yes.
Correct.
What BrightRock has done differently is sort of do needs-based. So sometimes you'll have R4 million life cover for whole of life, but actually you only want to insure that for 20 years because 2 of that 4 million is for your bond. So BrightRock gives you those options under your life cover to break up the different types. Then there's obviously disability cover, so that would be covering you if you became disabled until retirement age. And severe illness, they do offer to like till the age of 65. When we do it at our at Growth Financial Planning, we only ever do whole of life because you don't want to be insured for severe illness till the age of 65 and then at 70 the
More
cancer
likely
comes
to
in.
come in, yeah.
So I think, Sean, if you can maybe just explain the difference, because as mentioned, what happens with BrightRock is your premium goes up, but your cover goes down in certain instances, so depending on which one you select, but that is sort of for a reason. So if you're going to have bond cover, your bond isn't going to go up, it's going to go down, but the premium goes up. Do you want to maybe unpack that a bit?
Very often we hear competitors talk about the fact that BrightRock is a term cover product and a depreciating term cover. In other words, my cover is coming down. That's unfortunately not an accurate description, or quite ignorant in terms of understanding needs-match technology.
And term means it'll stop, which is also not true.
It won't stop.
Exactly.
And that is why we are the only company in the country today that can tell you next year, if your cover goes up, what percentage your premiums will go up by. You got to ask the question, why can't I get a CPI increase on my premium and a CPI increase on my cover with any other carrier? You can get one or the other. Okay, why? So we question that. So one of the biggest things that I will say to you that for us is a massive issue is the issue of protecting income. So if you think about it, right, and I'm not a financial planner, okay, as I explained in the previous series, I did my RE exam twice, but the reality is for the average South African or the average person, being able to protect an income or to provide income over their lifetime is the biggest single asset, okay, in a family. Now, income protection is grossly undersold. Okay?
100%.
Because most sales go, how much can you afford? There's a chunk of life cover. Yeah. Okay, instead of actually understanding the needs. So the very first thing you'll see on our product grid, okay, is household expenses income protection. Okay, and we split our income protection up between household expenses, in other words, your living costs, your childcare costs, okay, and your healthcare costs. Why? Because if you want to protect and accurately protect those needs, they're inflating at different rates. So when I drive past my children's school, it starts to suck my Prado in, okay, because my private school fees are not enough.
Exactly.
Okay, but they're inflating at 10% per annum. Okay, my medical aid is inflating at more than 10% on average. Okay, CPI is going up at whatever 5%. Okay, so in order to protect those income generating needs, we split that up, and then what we did was we said, what happens in the traditional income protection policy today, as we sit here? Okay, if I get diagnosed, okay, with, as we've just paid a claim for a doctor in Krugersdorp, okay, if I get diagnosed with cancer, as an example, I mean, prognostically, okay, I mean, and statistically, my longevity is going to be shortened. And so what happens if I have an income protection policy? It pays me out from day 7, okay, 7-day waiting period, and it stops the day I die. And we said, why? Why can't I, when I know what's wrong with me, capitalize all my future income amounts? So when you say that cover's coming down, it's not the cover coming down. That's the number of paychecks that you are protecting that is reducing as you get closer to your retirement age. So we are the only company that has the ability, okay, at claim stage to give you claim stage choice of taking the income amount or capitalizing all your future income amounts and taking it as a cash.
Warren,
If we can explain that in idiot terms. So
Yes.
let's say you've got 10 years left
we'll explain that, Doctor.
of your working career.
Yeah.
How does that work?
Okay, so let's if you don't mind, Warren, I'll explain the doctor. So the doctor's diagnosed with lymphatic cancer.
How old is he?
He's 40. Okay,
Sure.
he's diagnosed with lymphatic cancer. Okay, he was going to work till 65. Okay,
He can no longer work at all now.
Understood,
okay. He
Well,
might even be able to work.
He might be
okay?
able, yeah.
But he's got confirmed stage 4 lymphatic cancer.
Stage
okay?
4, yeah.
So, as a doctor, he knows that his longevity is going to be affected. In this case, it did. He died 4 years later. Okay, he was able to take 25 years worth of income, okay, and capitalize it at claim stage, which you cannot get in.
So what that means is,
I understand.
but let me just explain it a little bit further. So in most of the other insurance companies, he's been diagnosed with that stage 4 and he's insured for 60,000 Rand a month. He
And
will
he's
get
paid until he's
60,000
dead,
Rand a month every
For
single
4 years.
month for 4 years.
Yeah.
What BrightRock offers is you've been diagnosed with that. That 60 till the age of 65 would have actually been 6 million Rand. That client can choose to, I know, I'm not explaining to you, I'm explaining to the listeners. That client can take the 60,000 Rand, the 6 million Rand, and take that now instead of taking the 60
Massive
paychecks.
difference. Massive.
And that's very important, Ronald,
Very.
because by accurately mapping the protection of your paychecks, okay, so in this case it's 25 years worth of earnings, okay, and by accurately mapping them, okay, so in other words, in your last year, you've got 1 year's worth of paychecks to protect. That's where the competitors are saying the depreciating cover comes in, okay, but that's nonsense, okay. You accurately protecting the actual paychecks. Now, by shaping it like that, you're able to give people a hang of a lot more cover when they're 40 than they could traditionally buy with a normal product, okay, that is a whole of life policy, okay. Now, importantly, let's say I get to a point where I've outlived my need to protect my income. But bearing in mind that my premiums have gone up at a fixed percentage, okay? Even if they increase about 20% every 10 years, okay? At the end of the day, that premium is predictable. And that premium is an asset, okay, which no other company can say. Now, that asset, okay, if I have it, even if I've, and by the way, we've got income protection on death. Okay, why did we not sell income protection on death? Surely we should protect the family's income when the income owner's dead.
Yeah.
Okay, no one does that. Okay, we do it. And even if you've claimed, okay, on the policy, on our death column, that premium you can convert to whole of life cover when you no longer need to protect your income. And that's the flexibility I spoke about in the previous session when I spoke about our 3 pillars of efficiency, certainty, and flexibility. You know, so when people say your premium's going up but your cover's coming down, they're grossly misleading and not understanding the technology.
And what they must see is that exactly like you described it as an asset. Yes, your premium's going up, but you almost want it to go up a little bit because at that stage when you're now not protecting your salary, okay, you're going to need more severe illness cover, for example. So you can now take that premium that was going towards income protection, whereas at other places it would fall away, and now you can buy up R1 million worth of severe illness cover, which is the need you actually need at that time.
Correct. And
So
a lot of
that's how
people
it
will tell you,
goes.
sorry, Bron, I'm interrupting you, but you're quite right. You know, at the end of the day, a lot of people will say to you, but I pay the then premium rate. Okay, but your premium is predictable. Okay, so the PV of your premium, your present value, is constant.
Yeah.
You know, and people don't understand that. You know, because yes, life rates increase all the time. They have to. I mean,
The older you get,
and also, I mean, you know, you have a claims experience like COVID. You know, people will increase their premium.
And is that free of underwriting at that stage?
Yes.
So that's massive as well. Yeah. So if you have that income protection payment and then now you need to move it into severe illness cover, if you try to go get severe illness cover somewhere else, you might have diabetes or anything like that, you can't get the cover.
And that free of medical underwriting, okay? Obviously, financial underwriting, we can't over-insure people. It's against the Long-Term Insurance Act. But, you know, at the end of the day, that premium asset is so valuable. As I explained last time, I've seen it with my own policy. I moved my oldest son turned 24. I moved that premium. And you talk about additional expenses. We don't call it dread disease. We call it additional expenses needs, because you don't know what pool of money you'll need when you get sick. Okay, most of the time, if you ask people, have you got dread disease? Yes. How much? They don't know. Okay, and is it enough? We don't know.
Exactly.
Okay? I often say to people, we don't get invited to bras anymore. I'm just tell you. Okay? So it's like not fit
That's
for social
because you live in
consumption.
Benoni. I live there too, don't I?
We go to the dam. But at the end of the day, you sit at a bra and people, what do you do? Also, people working on. So I sell life cover, eh?
Yeah.
And then at that stage, the brandy and cokes disappear. But the reality is, I say to people, have you got life cover? I go, yeah, I got. How much? I don't know. But I'm worth more dead than alive. Eh? Most people will tell you, okay. But the point is, okay, well, you got 5 million life cover. Yeah, how much do you earn? 100,000 rand a month, or $1 million a year. What's 5 million going to buy you?
Yeah, you're not worth more.
Okay. How many years are you going to work for? You're 40. You're going to work to age 65. That's 25 years. You're earning $1 million a year. You need 25 million today, bud, if something happens to you.
Yeah.
Okay? But because my need has not been exposed. Okay? I've just bought a chunk of life cover. It's amorphous.
Yes, yeah.
So, yeah.
Awesome, thanks. Do you have any questions on any of that, Warren?
No, it's very nicely explained.
Awesome.
Sean, thanks for that.
Thank you so much, Sean.
Thanks, guys. Appreciate it.
Thank you for listening. If you have enjoyed this podcast, would like to subscribe, please visit our website, www.growthfp.co.za. The information we have provided in this podcast is our personal opinion. For more detailed information, please discuss your financial situation with a financial planner.